Good morning. I wanted to welcome everyone to the second quarter 2025 ISG Global Index call. My name is Moshe Katri. I'm a Managing Director, Investment Banking, focusing on tech-enabled services and fintech verticals at Wedbush Securities. I'd like to thank the team at ISG for their valued work on the industry and for asking us to introduce this call today. ISG has been hosting these index calls on the IT and business services industry for more than 20 years. The company influences about $200 billion of technology spending each year, providing deep insights into the industry as well as key changes in enterprise demand. And with that introduction, I'll turn it over to Stanton Jones, the distinguished analyst at ISG. Stanton?
Thanks, Moshe, and hi, everyone. So with me today is Steve Hull, Partner and President, ISG EMEA. Amartha Darshan, Chief Business Leader for ISG India. Alex Blocker, Distinguished Analyst, and Mark Smith, ISG Chief Software Analyst. This is our 91st consecutive ISG Index call, and it's hard to believe we're already halfway through the year. And if this is your first index call, some quick background. So the index measures the overall health and growth of the technology industry, which includes both managed technology services and cloud-based software and infrastructure services. And we do this by tracking and analyzing annual contract value, or ACV, as a leading indicator of where revenues are likely to be in the future. So think of ACV as bookings. So with that, Steve, I will turn it over to you to kick us off with a market level set.
Great. Well, thanks a lot, Stanton. And Moshe, thank you for hosting us again. It's great talking to you again. So let me start with, obviously there was a lot of significant macro and economic and geopolitical disruptions over the past 6 months. But despite that, I think the services and software sector really remained resilient. And I think you'll see that reflected in the numbers today. So first of all, when we look at it, coming into Q2, many of you remember we did the forecast for this in early April for Q2. It was just several days after all the tariffs were announced. So we were concerned about the impact of the U.S. tariffs on the broader market. We'd also saw a moderate slowdown in activity in the quarter. But when we had the 90-day extension to reach the trade deals, I don't think the market really overcorrected. I think we stayed steady there. So if I look at Q2, the managed services ACV was flat quarter over quarter and up 3% year to date. The market was pretty steady, but we continued to see longer decision cycles and some delayed projects. Banking and financial services are really beginning to show momentum. You're going to see that in the numbers. They were down. The sector was down 12% quarterly, but it was up 8% year over year and up 4.5% on a first half comparison. So we're definitely seeing the green shoots there. But the growth in BFSI was really driven by the Americas, and the sector was up almost 20% at the halfway point in the Americas. Large deal activity remained strong. We saw 8 mega deals in the quarter with an ACV greater than 50 million. That sector was up over 50%. I'd say the only caution, we did see a decline in smaller awards, which continued to put some pressure on that discretionary spending. Cloud-based infrastructure and software continued to expand really across all 3 major regions, really with sustained year-over-year growth that should continue into 2025. And finally, I'm going to give you a bit of an outlook here. I think we've avoided the bear case that we had called for managed services in April. Our overall forecast for managed services is going to be on the high end of our forecasted range, and we're actually going to increase the forecast for as a service. So there's some good highlights in the market as we go through it. But let's drill down into the broader market, Stanton. So the overall market was largely flat quarter over quarter, indicating some softness. I would say the number one thing this quarter was really that delayed decision making due to the unknown on the macroeconomic side. Year over year and half year comparisons, though, were strong, and the managed services and a service both at the half year point. You can see here that the cloud growth was exceptionally strong, primarily driven by the growth of AI. Cost optimization was really the main driver for managed services in the first half of the year. Again, the market was up 3% at the half year point, really driven by these cost optimization projects. And AI, again, both generative and agentic, is really being used to drive those cost savings and improve productivity. But much of those savings from those projects are being reinvested into other projects or being used to fund ongoing transformation projects. AI is also driving, strong cloud software and infrastructure growth as well. And with that sector up nearly 30% year to date, you're going to hear from Mark later to highlight how some of these changes are impacting the call. So Stan, you want to walk us through managed services?
Sure. Thanks, Steve. So as we mentioned earlier, large deal activity remains strong. So on the left-hand side of the chart here, you can see the ACV generated from mega deals, as Steve mentioned, through the first half of the year. And as a reminder, mega deal is an award with ACV of 100 million or more. So you can see here that mega award ACV is up 15% year to date, and that's on the same number of awards between 2024 and 2025. So in the data and on the ground with the clients, we continue to see large cost optimization focused deals coming together. But it's important also to keep in mind to drive these kind of savings, often significant transformation is required. And increasingly, AI is helping to make that happen. Also, as Steve mentioned, on the other end of the spectrum, we continue to see a pullback in the smallest deal category that we track. So those are deals with an ACV of 5 to 9 million. So overall, the number of these awards is down 10%, and that declines across all regions and service lines. And so this is a key indicator that discretionary spending remains under pressure. Okay, so let's move into the service lines. So first, we'll start with ITO. And as a reminder, ITO includes areas like applications development and maintenance, workplace services, and infrastructure managed services. So on the quarter, ITO was flat. However, on the half year, as you can see here on the slide, it was up just over 8% on a flat number of awards. Americas drove all the ITO growth in the first half, with EMEA flat and Asia Pacific down. Applications development and maintenance, or ADM, regained strength this year after being down for much of 2024. And that's great news for the sector, as it's nearly 60% of the ITO segment. And as you can see here, infrastructure remains solid, with data center and multifunction awards leading the way. Okay, let's pivot now to our second service line, which is engineering. So if you joined us on the Q1 call, you may recall that we started splitting engineering out last quarter, given the size and growth rate that we're seeing here. And that growth continued in the second quarter with 1.1 billion of ACV, which was up over 70%. That means that engineering was responsible for most of the industry's growth in the second quarter. And on the half year, engineering reached nearly 2 billion of ACV, and that's up 31%. That growth came from both the Americas and Europe, and from gains in the telco and transportation verticals. And the manufacturing sector was surprisingly resilient as well, with gains in aerospace, high tech, and semiconductors. So one of the key trends that we're seeing in engineering is the role that large integrated service providers are playing in the space. As you can see here, large providers account for nearly 60% of the annual contract value, or ACV, in the engineering segment, while the smaller pure play providers account for just over 40%. So we believe the larger providers are benefiting from a few things here. First of all, a more diversified business mix and environment where specific industry sectors are under pressure, for example, automotive, and due to their increasingly robust digital engineering capabilities, which we recently covered in our digital engineering provider lens study. Okay, Namratha, I'm going to come over to you for an update on BPO.
Thanks, Danton. Starting with the quarterly results, during the second quarter of this year, the BPO ACV of $1.7 billion was down 9%. On a regional basis, EMEA was a key contributor to the growth, as EMEA ACV was up 23%, while Americas declined by 20%. However, on the functional services like HRO, procurement, and finance and accounting, that was up 28% year on year, indicating increased demand for back office services. Now, moving on to half-yearly results, as you can see, BPO ACV declined by 25%, and that's largely attributed to the slow start in the first quarter of 2025. Customer experience declined by 9% on the other hand, but number of awards was up. This is an indication that the deal sizes are shrinking, AI is making inroads, and customer experience industry is also swiftly moving towards the tech plus agent arbitrage model. Speaking of customer experience, we just wrapped up more than 30 service provider conversations as part of our Provider Lens Contact Center Customer Experiences Services report. And here are some of the key trends that are redefining this industry. GenAI is definitely driving a lot of conversations, and CX is one of the areas where it can make a big impact with some of the promising use cases. At the same time, enterprise expectations from service providers on our ROI, be it productivity, efficiency, or cost savings, is increasing. A lot of these use cases have moved beyond POC and into production, but the industry is still sitting at a point where benefits at scale are being identified. Customer experience industry is witnessing a paradigm shift. As traditional services are becoming more commoditized, providers are investing in building platforms, industry accelerators, and reusable assets to help enterprises speed up their go-to-market. But like I mentioned, agent-led services are significantly changing into agent plus technology delivery model. Now, in order to address these changes, CX providers are obviously focused on investing in expanding their technology capabilities, highly focused on AI, data, and engineering capabilities. A lot of the hiring investments are happening to onboard these key skills, while the traditional agent hiring continues to be fairly muted. Now, in addition to all of these trends, the slower growth rate is also pushing these CX providers to rethink their strategy, driving many of them to pursue inorganic growth. We've seen several such acquisitions over the past year. Latest is Capgemini and WNS that was announced early this week, which not only signals a strong growth narrative, but also highlights the growing convergence of IT and BPO. And finally, moving forward, we believe that AI will continue to present a lot of opportunities, and providers who can bring differentiated capabilities, willingness to co-innovate, and deliver better ROI will sustain the growing competition. With that, Steve, back over to you for an update on the regions and industries.
Excellent, and thanks, Namratha. So let's start with the Americas. So in the Americas, really strong results this quarter. The second quarter ACV was nearly $6 billion, was up 7% quarter over quarter, 20% year over year, and up 11% at the first half comparison. The market really saw vigorous deal activity with almost 400 deals awarded in the quarter, and that was the highest deal count since the first quarter of 2022. We also saw a 40% increase in deals over 50 million of ACV, and 5 mega deals valued at over 725 million were awarded in the quarter. So a lot of deal activity at that other end, at that higher end. America's growth was led by BFSI, life sciences, and manufacturing, and these three accounted for almost 60% of the ACV awarded in the quarter. All three industries were up double digits at the half-year point as well. Conversely, the EMEA market really remained stressed. There was only 240 deals awarded in the quarter, which was the lowest in 3 years. The ACV of 3.9 billion was down 10% on a quarter-over-quarter basis and down 5% on a year-over-year basis. On a half-year basis, the region was up 3%, really based on the strong results that were posted in Q1. Energy and manufacturing posted the best first half results, with energy up almost 30% and manufacturing up 8%. BFSI, which is 20% of the market, was down almost 10% at the half-year point. From a regional perspective in Europe, France, DACH, and the Nordics all posted half-year returns in positive territory, which DACH, which now accounts for about 27% of the market, was up 20% on a quarter-over-quarter basis and 11% on a year-over-year basis. Unfortunately, the UK market, which still accounts for about 20% of the market, was down 31% quarter over quarter, 41% year over year, and down 23% on a first half basis. So there's still some continued challenge in the overall market in the UK. Asia Pacific sort of remained in the same range. We typically see Asia Pac anywhere between 800 million to 1.2 billion, sort of right in there. This quarter, we posted 820 million of ACV. Manufacturing and financial services really account for about 70% of the ACV in that market. Manufacturing was up 43% on a quarter over quarter basis, which was great, but was still down sort of 18% at the halfway point. So one of the things that's really important in Europe, I thought we'd just spend a few minutes on it, is the sovereign cloud discussion, or technical sovereignty, digital sovereignty. There's really this growing geopolitical uncertainty rising around AI regulation, data residency, digital sovereignty, specifically related to the sovereign cloud and solutions. And it's really becoming a strategic imperative across Europe. So, from a technical standpoint, the sovereign cloud really refers to cloud infrastructure and services that needs to comply with local data laws, ensure operational independence from non-EU jurisdictions, and are often supported by European providers or partnerships. We see this as a long-term shift and a growth opportunity in industry for both cloud providers, infrastructure providers, and software providers. So let me kind of go through three, kind of 5 key trends here. First, the public and industrial AI areas are really driving the sovereign cloud demand. Governments and critical industries are accelerating the cloud adoption to support both AI while really demanding compliance and governance, which is boosting the interest of sovereign IaaS and SaaS investments across the region. However, EMEA IaaS providers, the traditional hyperscalers, are still leading the growth. Matter of fact, for this quarter, EMEA really was the strongest growing region for all the hyperscalers. So, for example, IaaS spending in EMEA rose 41% year over year, 13% quarter over quarter, and it again was the fastest growing region. Microsoft, AWS, Google continue to invest heavily in the region and are deploying sovereign cloud solutions, while European enterprises continue to migrate core workloads to public and private clouds. So you're seeing the investment there. You're also seeing across Europe that the firms are deploying a layered architecture that really balances sovereignty, scalability, and innovation, and really continue to both on-prem, regional sovereign clouds, global hyperscalers, all combined to really maximize their flexibility. And, regulations continue to evolve, and they're continuing to shape the decisions. So regulations such as the Digital Markets Act, the AI Act, are all pushing CIOs, procurement leaders to prioritize compliance-ready platforms, which is impacting their sourcing decisions and their strategies across infrastructure and apps. And then finally, you've got a whole set of EU cloud providers. Organizations like OVH Cloud, T-Systems, Orange Business are all growing at 6% plus as a group this year. Again, you can compare that to the big three, which are sort of growing at 25%. You're starting to see this growth in the market. So now what I want to do is take a look at the industries. As many of you heard say many times, this is one of my favorite slides. We've changed it a little bit. We're going to really take a focus on 3 key industries. Don't worry, that slide is still in the pack. You can still get it if you download it. So let me start with BFSI. It's really recovering from the 2024 lows. In the second quarter, the BFSI ACV was up 8% on the half year, primarily due to strength in the Americas. We continue to see strong demand of integrated tech and business operations. So think of that full stack and industry-specific solutions in the middle office and back office operations. In energy, the ACV of $1.1 billion was up 20% quarter over quarter and up 25% at the half-year point. We continue to see really strong demand around SAP modernization and large-scale transformation projects. And finally, the CPG and retail sector is probably the sector that's been most impacted by tariffs, at least from an ACV perspective. Deal volume was up slightly, but the ACV was down 8% year over year and down 9% at the half-year point. I think the broadest trend in this sector is really the growth of hybrid global capability centers, or hybrid GCCs, which are starting to be deployed across many different solutions. So let's take a look at some of the other sections. Mark, let's take a look at SaaS.
Thanks so much, Steve. As a reminder, the SaaS segment spans horizontal and vertical business applications from front to back office, including IT, into the middleware, collaboration, underlying AI, and data software. The SaaS market ACV advanced 12% in the first half to $8.5 billion. and strong growth, narrowly outpacing the first half of 2024. Each of the regional markets contributed to ACV growth, with EMEA leading at 20%. The energy and telecom sectors had over 20+% ACV growth, with BFSI lowest at 3%. Let's dig down into some of the trends in the SaaS marketplace. For applications like Oracle and Salesforce, had 9% year-to-year ACV growth with continued AI investments. M&A news of Salesforce's to buy Informatica is exemplary of what is happening in the changes in the SaaS market. As we found with our real-time data buyer's guide rating and ranking of over 20 software writers, where Informatica was rated exemplary in their offering. In the front office application suites and CRM like Salesforce, it was down 8% year-to-year with ACV decline as enterprises reevaluate their strategy for AI modernization. As we found in our CXM buyer's guide research of over 25 software writers, like Salesforce was rated exemplary and is ready for some of the shifts towards customer experience from traditional CRM. Back office ERP with SAP S4 migrations, as Steve pointed out, require significant modernization in enterprises and had an 8% ACV year-to-year growth, specifically on the financial side of ERP, and a -2% year-to-year ACV growth for operations and services. As we found in our ERP research, SAP continues to grow and was found exemplary as part of our overall examination. IT platforms like ServiceNow and BMC grew at 61% year-to-year ACV growth for their assets, operations, and services capabilities, expanding now with AI and Gen AI self-service support. As we found in our ITSM research of over 15 software writers, ServiceNow still leads the pack and was rated exemplary. In the collaborative space in technologies like Google and Microsoft, they had 40% year-to-year ACV growth in this sector, driven by the advancements in conversational AI and generative AI as part of their offerings, things like Microsoft Copilot, Google Agent Space. AI is changing the SaaS market dramatically and what is available for enterprises and service providers to take advantage of. In the IS space, as a reminder, covering the cloud infrastructure and network and cyber security software, the first half had an ACV of $28.6 billion, continue with strong growth over the prior year. The Americas and EMEA region led growth with both 40% plus ACV year to date, with Asia Pacific had a solid 17+% ACV growth. And the retail and BFSI industries generated 48+% ACV growth, with energy at the lowest at 22%. Now, on the trend side, as a reminder in regards to the details of what's happening in the infrastructure area, the growth of IS was 34% ACV year to year, led by cloud hyperscalers like AWS and Azure, with their native AI and data platforms growing with agentic AI advancements. The big three hyperscalers, including Google Cloud Platform, grew significantly at 40% ACV year-to-year growth, and also with their technological advancements in supporting agentic and Gen AI capabilities. As Steve referenced earlier, the focus on sovereignty and the enterprise control of data for digital sovereignty requires new software provider investments to support the needs beyond what's already available in private cloud approaches. AI investments require expanded cloud and compute infrastructure, and we've seen providers like Microsoft and Oracle continue to advance in the work with their platforms to support data and the compute workload needs. In the cybersecurity segment, providers like CrowdStrike and Palo Alto continue to grow as the need for addressing threats and defensive enterprise investments continue to move forward with things like AI and now further challenges coming in the future in regards to quantum computing. As we found in our cyber buyer's guide research and endpoint detection response rating, providers like Palo Alto were found and rated exemplary. Stan, back over to you for the leaderboard.
Thanks, Mark. So as a reminder, providers on our leaderboard are listed in alphabetical order, and positioning is based on annual contract value, or ACV, signed over the past 12 months. The companies new to the leaderboard are denoted with an asterisk, and just as a reminder that the regional leaderboards can be accessed on the ISG website. Okay, let's start with the managed services leaderboard. Rejoining the Big 15 is NTT Data. They signed a 10-year network modernization deal with UPS. NTT Data will purchase and operate one of UPS's mission-critical data centers. In the Building 15 group, we highlight customer experience provider Concentrix, which signed a deal with Samsung Electronics in South Africa to open a business-to-business customer center. In the Breakthrough 15, we saw engineering services provider Globant rejoin the leaderboard. They started working with Argentina-based oil company YPF to leverage Globant's AI capabilities. And finally, in the Booming 15, Tata Elxsi announced a deal with Mercedes-Benz R&D India for vehicle software engineering. Mark, back over to you again for the as-a-service leaders.
Thanks, Stanton. In the Big 15, we highlight Oracle has been very successful in the last year in growing their SaaS and IaaS business. In our research published in June, we found Oracle with exemplary rating in our AI platforms buyer's guide. With their growth in OCI and its fiscal Q4 25 results ending in May, Oracle's revenue was at $15.9 billion and 11% year-over-year results. During the quarter, OCI won a deal at Enbridge, an energy infrastructure company, to expand the use of OCI for additional mission-critical workloads and leverage Oracle Exadata database service. They also won a software deal to help French luxury fashion channel Chanel manage its retail operations. And as many of you may have noted, the recent AI and cloud announcement with Microsoft and OpenAI provides a glimpse to its future revenue growth potential. In the Building 15, we have SaaS provider Snowflake joining the leaderboard. We recently rated them exemplary in our Agentic and Gen AI buyer's guide. Adding to its AI advancements with Cortex AI SQL and SnowConvert AI, and now with over $1 billion in revenue in its last Q1 reporting results with 25+% revenue growth year over year. During the quarter, they won large deals at global pharmaceutical leader AstraZeneca, German industrial giant Siemens, and banking leader JP Morgan. In the Breakthrough 15, we saw CRM provider HubSpot continue its growth with its last Q1 reporting results of $714 million, up 16% year over year. We recently rated them exemplary in our CXM buyer's guide. Its AI release of Breeze AI agents to support marketing, sales, service, customer, and transforming CRM seats, while providing its unique website and content management for a full customer engagement lifecycle. Its first move to integrate ChatGPT will ensure a better generative AI experience for anything an enterprise needs related to CRM. It has doubled its AI usage with over 660,000 users in Q1 and over 2,500 companies using the customer agent. Finally, in the Booming 15, we saw Guidewire join leaderboard as insurance software provider with its last Q3 25 results ending in April at $293 million of revenue and a 22% year-over-year growth. In the last quarter, its release of a Mammoth version of its platform supports workflows, templates, marketplaces for third parties, and an AI engine for predictive analytics. Its recent deployment at Farm Bureau Insurance Company of Idaho on the successful upgrade of its insurance suite to its cloud platform, and working with Value Momentum, a service provider partner. A good solid set of results in the leaderboard. Now over to Alex to cover more depth in AI with our latest research on the data tower. Alex?
Thanks, Mark. For the last year, ISG has been observing a change in the way that deals are being shaped around AI. We're beginning to see a segmentation in the way clients are sourcing their technology, and specifically a new way of sourcing for data operations and modernization in support of their AI adoption plans. Instead of leaving the work of data management as parts of thousands of individual applications, which hasn't worked well in the past, the new approach is shifting to having a provider get full oversight over data integration, use, and governance. Ultimately, this point of view helps the organization focus on using the data rather than spending their time preparing it. While we've been tracking the trend for a year, we recently completed a study to get some more information on how enterprise buyers are building out these programs. And some of the core findings are really telling, especially when we look at where the business achievement is contrasted with their expenditure on it. A lot of the core activities in the data tower fall into three major buckets. Circled in green here, the activities which are performing well: security, compliance, and backup and disaster recovery. Notably, all of these activities are reactive to external factors like third-party best practices and regulatory requirements. Then the core of the emerging data tower activities in blue. These are prerequisites to data use and analysis, understanding and documenting the business meaning in the data, managing access, and ensuring the data is accurate. While these represent a significant spread in investment, the commonality here is that these activities are still relatively immature. But that's okay because the core trend of building these capabilities together into deals is still nascent. And last, in red, realized AI productivity gains. It's clear that this is the objective because it's getting a very significant funding and continual market attention. But without the data tower in place and performing well, it's still doing poorly with regards to expectations. Now, shifting away from the prerequisites, another critical finding from our study was the significant variation by industry. In fact, challenges and priorities showed more variation by industry than any other study we've done over the last 3 years on any topic in IT. And it speaks how, from a technology and services point of view, much of the real variation between companies is in the different data they use and how they value and expect to derive value from it. Seen here is just a sample of this variation in challenges, and you can see that using the data for AI is a critical problem for most industries, while challenges around measuring ROI, data silos, complexity, and security all vary quite a bit. What this really indicates above all else is that industry expertise is of significant value for providers in the data tower market, as the challenges, priorities, and value from those data vary. Within this context, there is still opportunity for service providers, and it's growing. As we said earlier, we're already seeing deals emerge in the market where companies are sourcing this work. And what we see in the research is that there are tailwinds for the providers. Companies have intense pressure to move quickly, but they're constrained by a lack of expertise, their ability to hire, and their ability to train their own employees to work this way. And 60% of enterprises we studied plan to add service providers to support these data tower activities. Steve, back over to you to close us out with the forecast.
Great, thanks a lot. Hey, Mark and Alex, I think you both have highlighted the impact of AI across the industry, both from the data towers, but also how critical it is to the SaaS and infrastructure play. So really insightful. And I think we'll have to make all of our slides available to everybody that registers to make sure that they can get some of those insights out of it. So let me kind of wrap up the overall forecast. The overall technology services and software industry really remained resilient through the first half of the year. The quarter-over-quarter comparisons were weak, as I said, but the overall slowdown and slight uptick in managed services that was really driven by engineering services, which was up 30% quarter-over-quarter and 31% year-to-date. On a year-to-date basis, though, the managed services sector, we saw growth in ITO and engineering, while the BPO market remained weak. And again, as Mark stated, the as-a-service sector has seen 4 consecutive quarters with both infrastructure as a service and software as a service up. The big 3 hyperscalers continue to ramp up their CapEx investments to build out the infrastructures needed to support AI demand. And as Mark mentioned, we're also seeing strong demand in the SaaS segment. So I think overall, the macro outlook has improved over the last 90 days. However, I think business uncertainty remains cautious. AI spend continues to increase, and we're seeing efficiency improvements and first large-scale rollouts of agentic solutions. I think this increase in AI spending should offset any project delays or potential declines in managed services on the back half of the year. So in terms of the forecast, we're going to maintain the 1.3% growth for the managed services industry, which was at the high end of our range projected in April. The softness in Q2, which was offset by a significant increase in engineering services and continued delayed decision-making, and the decrease in smaller deals, all give us a little bit of caution despite the more positive half-year compares. So we're going to hold at the 1.3% growth rate for the year. We are going to raise the forecast, though, for as a service by 300 basis points to 21%. This is really based on the strong demand we're seeing on public and private cloud adoption, and as I mentioned, the tech sovereignty and AI-related transformation programs. So with that, we'd now like to end the formal call. We'll open it up for questions. Please type your questions in the comments. And then Moshe, let's have you start.
Hey, thanks. Great insights and great data. So I'm going to start with a couple. So we have an interesting kind of situation here. On one hand, you're seeing stock market indices at year highs, pointing to investors becoming maybe less sensitive to tariff talks and some of the other distractions. On the other hand, enterprises remain cautious, and that's reflected in continued pause in discretionary spending. Maybe you can talk about this discrepancy, and since you do have an open line with some of the enterprises, do you think that may actually change during the second half of the year?
Stan, you want me to take that one?
Yeah, please.
Yeah, absolutely. So thank you again, Moshe, for hosting. I think it's a really interesting question on a lot of fronts. So first of all, I'll put it in two letters. I think it's AI. And I think what I see on AI from the investor standpoint is there's so much interest and growth around that subject that I think we're seeing that play off with the GSIs. And quite frankly, the service providers have done a great job developing platforms, moving to nonlinear models. And so as you see sort of the market respond to that, I think we're going to continue to see that shift towards AI projects. Now, the dilemma is exactly what you said. The number of deals, the ACV, when you look at it, was fairly muted over the second quarter, during the tariff. But I think that was just delayed decision making. Certainly, when we're kicking the productivity, the efficiencies, the projects that we've discussed, all of that is going to raise the tide, I think, as we go forward. So I don't think they're really going in different directions. I think it's just this hype around, and good hype around, where we are from an agentic and Gen AI perspective.
Yeah, and Moshe, I would just add to that. I just think I know we talk about this every quarter, but I think it's important to keep in mind is just that when discretionary spending is under pressure, it has a different impact today than it did 5 years ago because of the degree to which ADM, that we talked about, that 60% of ITO ACV, 50% of all the ACV in the market. And you could say, 30 to 40% of an ADM deal is discretionary, project-based, T&M-based. So it just has a bigger impact now to the market. So that's the reason we watch that so closely, because it can have a bigger impact on, and I think that's one of the reasons we saw that largely flat quarter-over-quarter growth.
Okay, that makes sense. And then I have a couple of questions related to Gen AI. One, when do you think we reach critical mass in terms of scale? Obviously, we're talking about adoption. Next, which skill base is best equipped to kind of handle Gen AI enabled services and engagements? And then finally, and that's a big one, how disruptive, in your view, Gen AI is going to be to the space, specifically in terms of revenue cannibalization? And there continues to be a lot of conversation around that by investors.
All right,
Alex, I'm sorry, go ahead, Steve.
No, go ahead, Sam.
I was going to say, Alex, do you want to take a stab at some of that from the data that you're seeing?
Yeah, I'll start with the skills question, which is, in our data, we did see, kind of expressed challenges with hiring for these skills. Where I see the opportunity is service providers have long tried to differentiate by the industries they focused on. And enterprises are saying we need industry experience to help kind of navigate how AI should be used to make use of our data. And I think service providers that can actually bring industry experience at the data level to make AI work for those industries are going to be able to build out the use cases and the opportunities and actually get those productivity gains that everyone's looking for.
And Moshe, you asked about the impact on the sector. So obviously this is a red hot topic. I think we talked about this again last quarter. I think, clearly we are seeing an impact in terms of, I'd like to think about this more about the impact on the work rather than the cost or the price, because there's so many other variables that come into that. Absolutely. We are seeing an impact on, especially in areas like application modernization, where Gen AI is great because you can apply it to cloud migration, really good. Call it cloud or code migration, really good. Code modernization, not as good yet. I think it's safe to say, we're starting to see examples of, half the resources needed to do that kind of work. So that obviously leads to lots of commercial discussions. It also potentially means, okay, maybe the same amount of work gets done just in half the amount of time, or the same amount of time using that. You can play with those variables. Clearly, it's having an impact there. That said, I want to be careful with this is still, Gen AI emerged 2 years ago, right? We're seeing the contracts being signed now with these commitments around productivity improvements, which lead to out year cost improvements, continuing declining prices on a resource unit basis. But I think it's important to keep in mind that for the managed services work, not necessarily the application modernization work that's project based, for the managed services work, I think it's important to keep in mind that Gen AI it's another lever that's getting laid on top of the work that's been done for the past 2 decades around workflow and BPM and intelligent automation and RPA and all those things. So I would look at it as, in terms of the managed services work, it's just another tool that providers are going to use to remain competitive in the market. On the project basis, absolutely, it is significantly reducing the amount of time and effort it takes to get a lot of this modernization work done. So I think it's important to look at it from those two angles.
And I'll just make
and I would add to that. Oh,
go ahead, Alex.
I would just add also that as prices for those projects come down, there is not a shortage of demand for code to modernize. There's not a shortage of demand for applications to work on. We've seen pretty consistently in our studies over the last 2 years that the average enterprise consumer of managed services has between 1,500 and 2,000 applications.
Yep.
Yeah, I think from a agentic AI perspective, looking at the software economy, only a small number of the SaaS providers technically actually have agentic AI releases in their first generation capabilities. And agentic AI is not equal across all providers, whether or not it's the cloud layer, AI and data, it's at the application platform perspective, collaboration. So these are all just really starting to come out. So we're early in the phases here. And also make note that the pricing models from the software providers are varying in different approaches, where some are looking at consumption value-based pricing, and some are bundling it in. So we have yet to really see where this market will stabilize yet. But the next year to 2 years, we'll start to see more commonality of functions and also interoperability of the agentic AI layers across the software providers.
And in that context, Mark, I guess, this begs the question of how important the emergence of nonlinear growth models are going to be, or is going to be, for this industry, just if you want to keep on being relevant, and try, in terms of being able to get scale and survive.
That's absolutely true. And, for many software providers, it's how do you get to the, increased adoption at whatever cost, because you have to establish yourself as a key provider. And we've seen that activity with folks like Salesforce with Agentforce, or Microsoft Copilot, Google Agent Space. So it's really early on. And this also creates new opportunity from a skills perspective for service providers, because there's a lot to get your arms around in these early releases. And many service providers have their own agentic AI offerings. So for enterprises, it's still early in regards to making bets on which strategy and architectures are the best ones for their future.
Yep, that makes sense. I have 2 more to go. So continue to see 3 distinct growth areas in the space: product development, ER&D. Obviously, that part had very strong growth this quarter. And then Gen AI-enabled IT services. Maybe spend a minute or 2 on each one of those areas, just because, obviously everybody's looking for growth.
Sure, Moshe, I'll take the engineering side, and I'll turn it over to maybe Namratha to kind of talk about the integration of operations and IT around sort of the Gen AI enabled growth. So on the engineering side, yeah, as we talked about on the call, that really drove most of the growth in the second quarter. I think if you look at it on an industry basis, I think something really interesting around, and we talked about the growth in telco and media and transportation. I think, don't underestimate what's happening in energy right now. There's a lot of investment in technology happening in the energy sector right now, and that's driving a lot of that growth. We were actually, frankly, a little surprised to see the strength in maybe not strength, but how steady manufacturing was in terms of engineering growth across, as we talked about, aerospace, high tech, and semis, given the impact that we've seen in the due to the tariffs. So I would say, from our perspective, that engineering growth, continues to stay relatively strong in those sort of asset-heavy industries and those providers that are sort of building that scale. And as we talked about, at an integrated level across OT and IT and how those are converging, I think that they're taking advantage of those opportunities right now. And many of the smaller providers that are focused more specifically or have a lot more exposure to the automotive sector are seeing a bigger impact. Namratha, do you want to talk maybe about the kind of Gen AI convergence with BPO and that growth?
Yeah. No, I think applications was definitely one of the use cases. But if you look at the early on use cases, the customer experience and some of the back offices were the most prominent use cases that were identified when this whole Gen AI technology hype actually started. So now, if you look at where the BPO industry also stands, I think a lot of these use cases, like I mentioned a few minutes back, have actually moved beyond POC and into production, which means that the traditional BPO services, the companies, they're certainly sort of shifting their strategies. Like I mentioned, they're also kind of investing in expanding their tech capabilities, and which means that the traditional BPO services, where it was just limited to maybe just agent hiring, which is kind of expanding, and their service portfolios are now becoming tech heavy at the same time agent heavy, which is where the whole convergence of ITO and the BPO is something that we're seeing. In fact, recently we also came out of a lot of conversations where providers are also investing in a lot of tech startups ecosystem and growing, which is very unheard of, which is not something that the traditional BPO services used to happen. So I think somewhere the ITO companies are looking to sort of speak more the language of domain specialization, industry vertical knowledge. At the same time, BPO is learning to sort of speak a lot of the language about tech, and that's where the whole integration piece is starting to probably come together, and we might see more of such integrations sort of happening. But in general, I think Gen AI is kind of driving acquisitions, it's driving expansion of portfolios. At the same time, it's also giving a lot of use cases on the BPO side, which are kind of ripe for disruption.
Makes sense. And then the last one, and again, I just want to touch very quickly on GCCs. You spent a lot of time during the past calls talking about that. Anything different? Anything's changed this quarter that you wanted to kind of highlight? And thanks for the details.
Yeah, sure. Thanks much. Yeah, so we talked about this in the pre-call. So yeah, GCC remains red hot. We're kind of stuffed to the brim on the content for the call, so that's the reason we didn't include it. But yeah, it's still red hot. We actually have an event in Bangalore that Namratha is running here shortly with over 50 enterprise leaders. We literally had to cap off the attendance given the demand there. So still seeing very strong demand there. In terms of what's changed, I would say probably, and I'll ask my team to chime in here as well. I think that there is an increasing recognition that the hype around GCC, there's a ton of opportunity, but I think the reality is really setting in of sort of moving beyond the traditional GBS shared services model into more of an innovation hub, which is kind of what the market likes to talk about. There is an enormous amount of work to do to get there. Cultural change, operating model change. One of the key things we see in the data is sort of the integration with the business continues to be the big challenge. We see differences in what GCC leaders in India, sort of their expectations versus GCC leaders back at corporate. There's a lot of work to do there. And my perspective would be that enterprises are starting to recognize This is not just outsourcing where you do it yourself, right? This is a real big strategic change for the firm in order to get to the level that the industry is talking about. I don't know if my teammates agree with me there.
I think,
No,
Stan, the only big trend that we are seeing, and it goes sort of back to your first question, Moshe, when we think about engineering and product development, those are higher end services that are really becoming top line growth for enterprises. And so many enterprises are really moving to digital products, regardless of their industry, to drive the growth. So when they think about engaging with service providers, those two specific areas are the areas where they say they have the most interest in assessing different operating models that include the GCCs. Historically, what we've seen in this space for the last 20 years is global business services, shared services, very much a labor arbitrage chase for GCCs. They were only strategic in the sense that they reduce cost of labor for it. We're seeing much more focus now on those sort of labor arbitrage components being disrupted with agentic AI, or going to the service providers to really drive out different savings versus the labor arbitrage, or chasing across the globe where to do that. And much more strategic, as you said, with product development and engineering to drive those higher. I think that's good for the market. I think, again, as I said earlier, I think that's going to rise all boats. It's going to be, more spend that comes into the market, but it's also better for enterprise clients because now they can access world-class talent, world-class processes, and what we sort of think is a hybrid GCC approach that brings the best. So your question was spot on because it actually integrates all three of the big trends. Namratha and I are both going to be in Bangalore next week in India to really spend some time with some really hefty leaders, CEOs, managing directors of, I think it's almost 50 GCCs there, to really kind of explore these and what that means for the broader market.
Understood. Again, thanks, guys.
Awesome. Thanks, Moshe. Okay, we've got some time left for some more questions. So Mark, I'm gonna come to you first. We've got a question around agentic AI. So how real is agentic AI, and is the current agentic AI technology's disruption going to continue with software providers?
Yeah, thanks, Dan. Great question. Listen, I think, as we look at agentic AI, we are really in, kind of first gen releases with only a small percentage of the software providers. And you mostly see it in the largest software providers who have a larger percentage of their revenue allocated to R&D. So they're coming out with new things, and they'll continue because this is the future of the software platforms for enterprises, and is to layer the agentic AI on top of the Gen AI to be able to provide these kinds of workflows and automation and intelligence. So, for any enterprise, they're finding already that a lot of these are early, requires extra time and maybe patience. Also working with potentially their service providers in how these will play out. The big thing that's going to happen is really, as we look towards 2026, is interoperability of the underlying AI agents in agentic AI that will interoperate, let's say, from a ServiceNow to a Microsoft to a Salesforce. And we already saw some of these announcements and some of these demonstrations from those providers, along with Google Cloud Platform and their work. So this is going to be we're just going to be beginning to see more of the software industry leaning in. And it's also disruptive to them as well, because it changes how their models work, how their revenue and pricing models work, the expectations. These aren't humans, these are AI agents. How should they examine this kind of digital labor? So there's multiple facets to the readiness of software writers, and frankly, the readiness, as Alex pointed out, in regards to skill sets. They're going to be required to really take this to the next level, because it's not just generic skill sets. There are very specific skill sets for particular software writers, and some are easier and some are a lot more difficult.
Okay, thanks, Mark. Alex, going to come to you next. I think we got time for at least two more questions. We've got a question around what types of data are seen as most valuable right now.
So I think this is an interesting question. Obviously, one of the characteristics we saw earlier was like a lot of industry variation. But one of the areas of convergence here is that almost everyone is prioritizing kind of your CRM data and your sales performance management earliest. They're thinking that those are the most likely to move the needle on revenue, and getting more insights out of that and about the customer profiles embedded in your CRM systems gives you something to drive profitability as well. Now, kind of second from that, we see a trend when we ask about, how well integrated is your data? What is your status quo right now for your data operations overall? That the kind of default tabular data sets are the ones that are the most well integrated. So things like your IT logs and your F&A, those data sets are very structured already. And those tend to be the most integrated. But the biggest opportunity tends to be in the kind of next level down of data that is less structured. And this ties back to a lot of the discussions on engineering services and product development and those kind of emerging services growth areas where organizations are focused on their product data. They're trying to figure out how to get the next level deep on not just thinking about their F&A and their sales, but trying to bring to light more information out of their product development cycle and their the kind of industry specific use data that is often less structured and spread over more applications.
Okay, thanks, Alex. I think we've got time for one more question. This one deserves probably an entire call, but let's see if we can do it in a couple of minutes, Steve. So is AI eating into tech budgets?
Yeah, that's one that could definitely take another hour. Let me start off with the easy answer is absolutely yes. And it's across multiple channels. I think, Mark, you did a great job sort of highlighting that SaaS providers are investing a tremendous amount into their agentic AI solutions and generative AI solutions, but it's still early days. But they've increased all their prices and everything for it. Clients are implementing Copilot across the board. They're implementing OpenAI, Enterprise Gen AI across the board. So there's a lot of additional costs that are coming in. Plus, we have this tokenization. You have to pay for data access. You have to pay for the tokens as they go forward. And there's not a good model for that now. We know data is dropping significantly. We know GPU prices have dropped significantly. We know tokenization has dropped almost 99% since it was first rolled out. But all of those are adding costs to the IT budget. So when we see cloud costs go up, a big percentage of that has to do with AI components doing it. We see SaaS prices go up. A lot of that has to do with the embedded AI. But we're not seeing the productivity release where we're getting efficiencies yet. Now, we all believe that that's going to come, but we haven't seen that. And Alex, I think you did a great study a couple quarters ago, I believe, where I think it was 5.5 or 6% increase in the tech budget because of AI. And everybody's hoping we'll get that offset, but we haven't quite got it. So this may be an interesting one, guys, that we really put a white paper together. So because there's some really key trends that are impacting it, yet we're not seeing the productivity. And if I'm a CIO right now, I'm struggling with how to adopt all this new tech with my budget not going up, but everybody pounding on my door that they want more AI. So it's an interesting dilemma. It's not like CIOs, we don't always have lots of challenges, but this is definitely a bigger one because of all the promise that it brings.
You're right, Steve. It's not just, as a former CIO, it's not just more with the same, it's more with less.
Exactly.
That's the key.
And that less is going to different places. You're no longer spending that on bespoke apps or SAP. It's, you got to spend it in other areas.
Right. Okay, we're going to go ahead and close out the call. We've got a ton of additional questions. Sorry we couldn't get to those. So make sure and follow up with anyone you see here on the team, and we're happy to connect. Moshe, big thanks to you and your team for hosting the call today. As a reminder, you can access a copy of the slides that you saw today and the regional leaderboards on the ISG website. And we will see you on the third quarter 2025 call in October. Thanks.